Many people use the term accounting and finance and they don't really understand the meaning behind both of these terms. Accounting is the recording and tracking of financial transactions, and finance is the usage of actual money. Let's look at a very common example. You have a credit card loan to the value of $550, and on top of this you also have $75 cash in your pocket. Now, in accounting, you would be worth minus 475, but in finance, you have 75. This is kind of nuts, right? Because you can't really walk around with minus 475 in your pocket. You see, an accountant will produce reports that tell you how you got where you are. A finance person will tell you where to go next. Before we get into this in more detail, stick around to the end and I'll tell you how you can get a download PDF cheat sheet giving you all the main points of this video. And if you're liking this video, don't forget to give it the thumbs up. Accountants generally look at past financial transactions. In essence, a business entity will make financial transactions, sales, purchases, and so forth. And an accountant will record these transactions in a way that they can report. Now, these reports are in the form of income statements and balance sheets and cash flows. And what they all have in common is that they look to the past. It's historical. But the reports do accurately represent how the entity has gotten to the current cash position. Now, accounting and preparing the financial statements are all based around the accounting equation. And the accounting equation basically says assets equals liabilities plus equity. What I have, what I owe, and what I own. For example, you have a house, what I have. You owe your mortgage, what you owe, and you own the equity, what you own. This accounting equation, assets equals liabilities plus equity, might seem relatively simple, but you see, accountants have had to overcome multiple complex problems and complicated situations, and they've overcome this in a standardized format that's globally regulated. Now, what does this mean? This means that you can take a set of financial statements from two companies anywhere around the world and you can easily compare the two of them against each other. Another thing to note about accountants is what accountants consider to be risk. So for an accountant, risk is the chance of a material error or omission in the financial statements. Now remember this, because I'm going to be talking about risk from a finance perspective later on in this lesson. Finance people, they look to the future. They're going to take the help of an accountant by using financial reports that the accountant produce to get increase in revenue, reduction in costs, increase in bottom line, and increase in return on investment. Finance people make assumptions that inform business decisions of the future. Now, the finance equation is rather simple, and the finance equation basically says income equals revenue less costs. Now, revenue can also be calculated very easily, and it's basically the price of your item or your service multiplied by the volume units sold or your hours billed. And the costs can be calculated as well as variable costs, such as the cost of sales or labour based on output, plus your fixed costs, such as director salaries. Now, I spoke about risk earlier on from the viewpoint of an accountant, and it's the risk that the financial statements that look to the past are incorrect. Now, from a finance viewpoint, the risk is entirely different. The risk taken by finance people is that the assumptions about the future are going to be incorrect. Now, the variance between the actual and the expected is the risk. Investing is a huge part of finance, and it's a little different to the corporate accounting and finance that I'm after been talking about so far. Investors are looking at different companies, different entities and different products to actually invest in. And what they do is they begin with the financial statements produced by the accountant, and this tells them how much cash they have in the bank and how the business has performed up until this point in time. The investor then has to decide what the assumptions are for the future and where the investment should be made in order for them to get the best return on the money that they have invested. So I have a really handy resource available for you, a PDF that you can keep as a reference to the key points in this video. And all you have to do is hop over to my bookkeeping courses using the link now on the video or in the video description, and you can find out how to download the PDF. Don't forget to subscribe and give the video a thumbs up. Thank you. Bye bye.